Hello, students. Welcome to Unit 6, the Open Economy. This is the final unit of macroeconomics. You are so close. So let's dive right in. We're looking at the economics of trade and exchange. So far, we've looked at everything that happens within the borders of our nation, but we know that there's something called net exports out there, that there's an exchange that happens between countries. And it's not just goods and services, but it's financial transactions as well. So that's what we're going to try to break down. The way that economists track this exchange is using a balancing accounting system called the balance of payments. So the balance of payments tracks all money going out and all money coming in. And really, you can break this down into two basic categories for international exchange. We have sort of the money going out back and forth for the exchange of goods, and then we have the money going back and forth for the exchange of financial assets or interest bearing assets like bonds. Right? So we're going to put those into two different categories. And remember, whenever you're doing accounting, the two sides have to balance. Mainly what you're going to be able to be asked to do is not actually balance these out like we did in the banking balance sheet, but instead you're going to be asked to identify how this is affecting the capital or the current account, for example. So, in my opinion, the easiest way to do this is just think about where the money is going. Who's getting the money? So the flow of the money. For example, when I export a good, right? The goods are going out. What's happening to the money? Well, the money is flowing in, and vice versa, right? If I'm buying a bond in Japan, who's getting the bond? I'm getting the bond. Bond's coming in, but the money for the bond is flowing out. If we keep that in mind, then we're going to be able to effectively track this. All right, here we go. So we call this the balance of payments. The balance of payments is a balance of all international transactions, a full, complete summary of international trade and exchange, not just goods and services, but also assets, interest bearing assets, financial accounts, things like that. Okay, there are two accounts that always have to balance because that's accounting, which is the current account. Current account is exchange. Here, got to show you the elephant. There we go. Exchange of goods and services, right? This is what we normally think of when we think of international exchange. And then we also have the financial account, which is the exchange of those interest bearing assets. And those two sides will always balance out. Reason they'll balance out is, when I'm sending an export out, that's a flow inflow of money coming in, outflow of goods going out. So for them, it's an outflow of goods, it's an inflow of money, right? So that's how that works. Whenever we have goods going one way, we have money coming the other way. So they're always going to balance. All right, so let's get into it. Current, I call this the one and done account. The current account, the one and done, right? It's got three basic parts we're going to break down further. First, the balance of trade. This is exports minus imports. One and done, right? Somebody buys a good from another nation, or I export a good to another nation. That would be balance of trade under the current account. Next is the net investment income. This is money you make off of investments that you did previously, right? So, for example, it's the dividends, which is investment money, paid to US investors for their overseas investment minus the dividends paid to foreign investors for the investment in US. In other words, let's say I buy a factory in Japan. When I get the profits from that factory, they pay them to me. So that's inflow. That's a US investor. I have an overseas investment. I make money off of that. That's going to be an inflow. That's going to be green, right? But when Japan owns a bowling alley here in the United States, when they get a profit margin from that, that's going to be outflow from the United States bowling alley to Japan. So it's those inflows of the United States investors, our foreign investments, inflows of that money we're getting, the dividend, the profits we get from that, minus the outflow, which is foreign investors, the investments they have in the United States when those profits are paid out. So that's net investment income made off of our investments. And then finally, net transfers. These are transfers paid to the United States from foreign nations, minus transfers from the United States to foreign nations. So transfer payments oftentimes are like aid, for example, right? When the United States had Hurricane Katrina, nations from all over the world sent aid to the United States. that aid coming in was green. That was positive. That's inflow, right? Money flowing in. In the United States, say, is helping out with the drought in Zimbabwe, that's going to be an export or an outflow of money to Zimbabwe. That's how that works. So inflow minus outflow, and follow the money. For balance of trade or for income and transfers, the money's basically what we're talking about. Balance of trade, the money goes in the opposite way of the goods. But an export is positive because the money is flowing in, and an import is negative because the goods are coming in, but the money is flowing out. Inflow versus outflow. All right, let's break it down a little bit further. Balance of trade, net exports, exports minus imports. So there you go, those things. Remember, when exports are greater than imports, we call that a trade surplus. And when imports are greater than exports, we call that a trade deficit. So keep that in mind, because sometimes they'll just tell you have a trade surplus. What's going on there? That means you have more inflow than outflow, right? Because I have more exports than imports if I have a trade surplus, and vice versa. Okay, and then we're going to have to figure out how to debit and credit those, which I'm going to talk about here in a second. Net investment income, remember that's money earned from an investment. So if I own a company, for example, I grew up in Marysville, Ohio, where Honda of America was headquartered. Honda of America, the people that own that are Japanese. When those Japanese owners make their profits from that Honda, right? That's outflow to Japan, which means that's going to be a negative in our net investment income. And then when the United States investors, let's say Walmart in, I don't know, Mexico, the people who own Walmart are American. So when Walmart makes profit from their Mexican properties, that profit flows to the United States. So that's going to be green, that's going to be positive, that's going to be inflow to the US. And then net transfer, those are those donations, aid, official assistance, remittance. What's remittance? This is a key word here. Remittance is when people work, for example, in the United States, and then they send money home to take care of their families, right? We call that remittance payments. So we see this with our labor market, mainly our unskilled labor market in the United States. We have several people in our unskilled labor market that come from, say, Mexico or Guatemala or something like that, who work here in the United States and then send a large portion of their money back home to take care of their families. That's outflow. That's money going from the individual to Mexico. So that's going to be a negative or outflow. And vice versa. If I move to England and I decide to work there and I'm sending money from my job back to take care of my family, then that would be inflow because I would have remittance from England to the United States. Again, follow the flow of the money. Where is the money going? It's going into the nation, so that's plus. Going out of the nation, that's negative outflow. Okay, so debit in the balance of trade, investment income, or net transfer, it's a decrease in the current account. I don't know why it looks like that. But debits are decreases. This, for my accounting students especially, this is kind of counterintuitive. The reason is a current account holds a credit balance. And so a debit is actually a decrease. Think of it like a debit card. Whenever you use a debit card, it takes money out of your account, it debits it from your account, it removes it, it goes lower. But any decrease is going to be a debit, which means that any increase of the three is going to be a credit. I don't know what just happened. Hold on. Am I still working? I sure hope so. I don't want to record this whole thing over again. Looks like it's still working. I will find out after I'm done with the whole thing. And you will find out as it's going, because if you can hear me talking right now, it's still working. Where were we at? We were here. So hope you had a good Thanksgiving. I had a good Thanksgiving. Had some turkey. It was delicious. There we go. I think it's working. There we go. Okay. So if there's a credit in any of the three, it's an increase in the current account. A credit, or like a credit to you, is an increase. It goes bigger. So think of it like a credit card. Whenever you use a credit card, it actually increases the balance of your credit. It goes up, right? So debit is going down, debit decrease, credit is going up, credit increase. Whenever you have a decrease in your balance of trade, net investment income, or net transfers, debit. Credit any of those three, it's going to be positive. Okay. The second account is called the financial account or the capital account. It's called both of those things. So the other one is current account, current, one and done. The other one is financial or capital account. And it has a few items. First, net asset purchases. Current account tracks the money you make from an investment. Financial account tracks when you actually purchase the investment for the first time. It'll make you money in the future, but the initial purchase of that investment is considered a financial purchase or the purchase of a financial asset. Right? So it measures the purchase and sale of financial assets. Financial assets is anything that has a future or continual earning potential, right? So if I buy, I don't know, a ski resort in Norway, it has potential to make me money in the future. I'm not buying that because it satisfies my utility. I'm buying it because I want to make money off of it in the future. It's a financial asset that I am purchasing. And so that would count as an outflow or a negative because I'm purchasing a ski resort in Norway, right? So for Norway, look at that. So, for example, if the United States purchases a government bond from Norway, that's going to be outflow. The initial purchase of that bond is going to be outflow. But when I make money off of that bond in the future, that's going to be tracked in the current account. So I have outflow because I purchased the bond. Money went to Norway, right? And then I'll have inflow in the future because that money will be coming back in the form of interest payments or income that I make off of it in my current account. Now you should start to see why the two sides balance. Current account tracks the money coming back and forth from the profits we make off of our assets, but the initial purchase of the asset is going to happen when I buy it, and it's going to be tracked in the financial account. A Japanese company purchases a company in the United States. If Japan purchases a US company, that money is coming into the United States. So it's going to be inflow in our financial account. It gives them future earning potential. And then in the future, when Japan earns that money off of that company, that's going to be tracked in the current account. Initial purchase, financial account, future profits, current account. Okay. Net asset purchases. A negative net asset purchase is going to be a decrease in the financial account, and a positive net asset purchase is going to be an increase in the financial account. All that to say, if I have more assets being purchased in the United States versus over there, if other nations are purchasing more United States assets, that's inflow, that's going to be positive, and that's going to be an increase in the financial account. But if other nations or if the United States is buying more financial assets in other nations than they're buying from us, a negative net asset purchase, and that's going to be a decrease in the financial account. In addition to that, we also have something called the capital account. So far we have net assets purchase, which is the United States purchasing assets overseas. That's negative. Overseas nations purchasing assets in the United States. That's positive, right? Positive minus negative equals net assets purchase. Capital account is less common. Normally, I don't ask a question about this, but it's the forgiveness of debt. It's a positive when other nations forgive U.S. debt, right? They say, hey, you know what? You don't owe us that anymore. That's positive. We consider that inflow. When the United States forgives other nations' debt to us, right? You owe us money, but we're not going to make you pay it. That's going to be a negative. That's considered outflow, right? We didn't get the money that we're expecting to get. So that's the capital account. It's all about forgiveness of domestic debt. There you go. So the financial account and the current account will all balance out. That's what that says there. All right, there's your balance of payments. Current account and capital account balance out. Any difference between the two is whatever the cash is on hand when people hold things as cash. you don't have to worry about that. Again, you're not going to be balancing these out. You're going to be given examples and have to tell us what's actually happening. Okay, speaking of, I think this is where the rubber hits the road. It sounds really complex, but when you start to exercise it, you're going to see that it's actually pretty simple. Okay, let's try this out. First, let's say Bill, who's an American, invests $20,000 in a ski resort in Canada. Okay, so what's he doing? Is he purchasing a good or service? No. So it's not that in the current account. Is he getting income off of a future investment? No, right? He's not making money off of this yet. So it's not that in the current account. Is there remittance or transfer payments here? No. Okay, so must be over in the financial account. What's going on there? Is he purchasing an asset that has a future earning potential? Yes, he is, right? He absolutely is. So is this going to be a debit, which is a negative, or a credit, which is a positive? Debit, negative, credit, positive. Well, where's it going? Well, it's flowing from the US out to Canada. So this is outflow. It is negative. That money is leaving the United States, going to Canada. So it is going to be a debit in the financial account. Okay, so far so good. Let's check out the next one. There's a Korean company. They sell uniforms to the United States military. Korea selling uniforms to the US. What's this? Well, is this a purchase of a good or service? Yes. Yes, it is, right? The United States is purchasing uniforms from Korea. Is that an import or an export? Well, that's an import. Uniforms are coming in. What's happening to the money? Is it flowing in or flowing out? Well, it's outflow. So that's going to be negative. So this is going to be a debit in the current account. Which part of it? Of course, this is the balance of trade, exports minus imports. Let's try the next one. There's a US company and they sell airplanes to France. Okay. So this the purchase or exchange of goods and services? Yes, it is. The United States is selling planes to France. Is that an export or an import? Well, that's an export. So what's happening with the money? Is money flowing into the United States or flowing out? Well, if the US sells planes to France, then there must be inflow. So this has to be positive. Of course, this is going to be a current account credit in the balance of trade. Okay, let's try the next one. There's a Chinese company that buys a shopping mall in Delaware. Okay, so they're buying a shopping mall in Delaware, maybe not the best investment. Is this a purchase of a good or service? No, so it's not that in the current account. Is this money or profits earned off of a previous investment? No, so it's not going to be that. Is this a remittance or transfer payment? No, it's not that. Is this a purchase of an asset that has the potential to earn profit in the future? Yes, ding, ding, ding. This must be a financial account transaction. Now, where's the money flowing? Is the money flowing out to Delaware, or I'm sorry, out to China, or is it flowing into the United States? And the answer is, of course, into the United States. So this is inflow, it's positive, so it must be a credit in the financial account. Okay, let's keep going. There's an immigrant that lives in the United States and is sending money back to their family in Syria. Okay, so is this the exchange of goods and services under current account? No, it's not. Is this profit made off of a previous investment? No, it's not. Is this a transfer payment? Absolutely. What kind of transfer payment is this? Well, this is remittance. This is when somebody earns money here and sends it abroad. What's the flow of the money? Is flowing money flowing into the United States or out of it? And the answer, of course, is out. It's going to Syria, so it's flowing out. It's going to be negative. Negative is a debit. It's going to be a debit in the credit account because there's a remittance or a transfer payment. Try another one. There's an American that earns $10 million from a company that he or she owns in Italy. Okay, is this the exchange of goods and services? No, it's not balance of trade. Is this profit earned off of a previous investment? Ding, ding, ding. Yes, it is. That means it must be in the current account. Is the money flowing in or flowing out? Well, it's flowing in, so it must be a credit. So it's a current account credit because it's profit earned off of a previous investment. Okay, so these are hard and fast rules. If you know what each of the accounts are, the three parts on the current account, two parts on the financial account and you track the flow of the money, is money flowing in or out, you're going to be in really good shape on these. Now, there are a few determinants that you need to know that can change the balance of payments, right? So, first are interest rates. Think of it this way: when interest rates go up, then the assets, like the bonds the United States has, are more attractive to foreign investors. They want our assets because they pay a higher return than the assets that they have at home. So our financial account is going to increase towards a surplus. Why? Because more foreign nations are going to buy more American bonds, which is going to be an inflow of money. So there's going to be a bunch of financial account credits, which means that it's going to move towards a surplus or being positive. Make sense? If interest rates drop compared to foreign nations, then assets are less attractive. The United States bonds are less attractive than they were before, which means that people are not going to demand our bonds anymore, and our financial account is going to decrease towards a deficit, right? They used to have money coming in, there used to be inflow, but there isn't anymore. In fact, the United States is probably buying bonds abroad because they have higher financial assets or higher interest rates. So there's going to be outflow, which is going to be negative. It's going to pull down our financial account as there are more and more debits on our account. Okay, so that's interest rates. Interest rates have a direct relationship with the financial account, right? They impact that directly. In addition, we have national income. Income is going to affect our current account. When other nations' incomes rise at a greater rate than the United States, they're going to buy more of our exports. They have more money, they buy more of our exports as a result. We buy fewer of their imports because our incomes aren't rising at high of a rate. So our current account, if other nations are buying more of our exports, we have money flowing in, we have a whole lot of credits coming in, our current account is going to increase towards a surplus. And vice versa. When other nations make less money, when their GDP is falling, they're less likely to buy our exports. But we are more likely to buy their imports. And so we have outflow. There's more money flowing out. There's less money flowing in because they're not buying our exports, which means our current account is going to move towards a deficit or a negative as we have outflow occurring. Okay? Again, just follow the flow. Last one: appreciation and depreciation of currency. We're going to spend some time here later, so I'll go through it quickly. If it doesn't completely click, that's okay. Appreciation and depreciation of currency. First, know that when currency depreciates, it means it's decreasing in value relative to other currencies. If our currency depreciates, it means that we're going to buy fewer imports because they're going to look relatively more expensive. But other nations are going to buy more exports because our exports look relatively less expensive to them because our currency has depreciated. So as a result, our current account is going to move towards a surplus. Depreciation leads to higher exports, which leads to a current account moving towards a surplus. And vice versa, when our currency appreciates, exports are going to be less attractive because our goods are going to look relatively more expensive, right? When they exchange their currency to buy our goods, they're going to get less American dollars for every euro or every yen or every yuan or whatever it is that they're exchanging. As a result, we have our current account decreasing towards a deficit. In other words, there's an inverse relationship here between appreciation and our current account. If our currency depreciates, our current account moves towards a surplus. If our currency appreciates, our current account is going to move towards a deficit. Okay? All right. Final little exercise. This might be helpful for you, it might not, but think of it this way. Our ABAS model is kind of like the current account, the one and done, right? Goods flowing in and flowing out. And our net exports shows up on there. And our loanable funds market is sort of like our financial account, right? Money flowing in, money flowing out. So if the United States and China have balanced trade, what happens on the graphs if US imports more from China? Well, if the United States increases their imports, then aggregate demand is going to shift to the left because net exports has fallen, right? You know that. And from China's perspective, net exports have risen because they're exporting more goods to the United States. Net exports is the Ixon of Sig Jigson, so aggregate demand is going to shift to the right. At the same time, the flow has changed, right? In the United States of America, we're going to supply, I'm sorry, in China, the animation, in China, they're going to supply fewer loanable funds. As a result, their capital flow is going to go down, right? When they're buying more, when they have more imports, or I'm sorry, they have more exports, then there's more flow coming in, then they're going to save less money. So supply is going to shift to left, interest rates are going to rise, and vice versa. Capital flow for the United States is going to be up. All that to say, when this one thing happens, our current account is going to move into a deficit for the US. The current account is going to be in a surplus for China. And the opposite is true. The financial account is going to move to a deficit in China because they have to balance. And the financial account is going to move to a surplus in the United States because they have to balance. Okay? So, again, that might be helpful for you. That might not be helpful for you. So, if it's not helpful, just completely ignore it. Memorize your current account, the three types of current account, the two in the financial account, the debit and the credit, and then know your three determinants. What happens when national incomes rise, interest rates rise, or there's appreciation of currency. Okay, that's it for concept 6.1. It's a big one. Next up is 6.2 and 3. Have a wonderful day here at CVCA.